and welcome to Business Daily. I'm Lee Ji-yoon in Seoul. Before we get started, let's first get a quick check of today's highlights. Higher grocery bills for Koreans drove up consumer prices in January to log the fastest pace of inflation in more than 4 years. The Trump administration has slammed Germany, China, and Japan for alleged currency devaluation. Is the world headed for a currency clash? We'll sit down with an expert to talk about this. Rapidly rising food costs pushed overall consumer prices in January up to levels not seen since late 2012. The devastating bird flu outbreak, coupled with a poor supply of farm goods from last year, are now hitting consumers in the wallet. Our Shin Se-min starts us off.
Korea's consumer prices rose by 2% on year in January. That's the steepest growth seen since October 2012 and is also the first time since then that the figure has hit the 2% range. Since September, inflation has been floating in the 1% range. In the few months before that, prices were only edging up by between 0 to 1%. Compared to the month before, the index for January is up 0.9%. Statistics Korea says the hike in the consumer price index comes on the back of a sharp increase in food prices. The statistics agency says rising prices of farm products like fresh fruit and other agricultural goods drove up the consumer price index. Fresh fruit and vegetable prices soared 12% last month from a year ago due to a supply shortage caused by the prolonged heat wave and a typhoon that hit the nation last summer. Livestock products spiked 9.5% on year after Korea was hit by its worst ever bird flu outbreak, a crisis that triggered the culling of millions of chickens and ducks in a period of just 2 months. As a result, egg prices skyrocketed by nearly 62% on year last month. Beef prices jumped by slightly under 5%. The rise in food prices is being heavily felt by consumers, reflected in the Consumer Sentiment Index last month, which fell to its lowest level since early 2009 during the global financial crisis. Core inflation, which excludes volatile oil and food prices, rose at a slower pace at 1.5% compared to the year before. Until the latest figures, inflation had been lagging behind the central bank's target for months on end, even after the Bank of Korea lowered it to 2% at the beginning of last year. Shin Se-min, Business Daily.
The negative impacts of a slow-growing economy are far-reaching, including the large number of layoffs across multiple industries. Now, the effects are more devastating for low-income families who have seen their income shrink. Our Lee Ju-young has more.
Weak domestic consumption and slowing exports. These are just a couple of reasons why Korea has posted low economic growth of less than 3% for the past few years. While weak growth is bad news across the board, its impact has particularly taken a toll on low-income households. According to Statistics Korea, the nation's poorest 20% saw their average monthly income dip over 1% back in 2013, dropping for the first time in 7 years. Things improved in the following 2 years, but then took a 13.4% plunge in the first 9 months of last year. That means for someone earning about $1,000 on average a month, they would have seen their income shrink to under $900 last year. Much of this is due to heavy restructuring seen in industries that employ many Koreans in the lower income brackets. Citing data from the third quarter last year, the Labor Ministry said a total of about 34,000 temporary and day laborers lost their jobs in these 4 main industries, with the construction sector laying off the biggest number of people. To ease such hardships, the government has listed job creation as its top priority for this year. It has also vowed to pull up the job application period for civil servants and public institutions to sometime in the first quarter and spend much of the allocated budget during that period as well. But experts say more long-term measures are necessary, like introducing unemployment assistance programs and increasing the minimum wage to better prop up the livelihoods of low-income families. Lee Ju-young, Business Daily.
It was all smiles for Korean automaker Hyundai Motor in the first month of the year on the back of strong sales in the United States. But with Donald Trump stepping up his protectionist rhetoric, it seems that the Korean automaker is gearing up to respond. Our Kim Min-ji has this report.
Hyundai Motor saw steady sales growth in the U.S. market in January. The automaker, Korea's largest, sold over 46,500 cars in the U.S. last month, up 3.3% from a year ago. The solid performance was led by strong sales of the automaker's sports utility vehicles, including the Santa Fe and the Tucson. Sales of the Santa Fe rose more than 53% from the same period last year to over 7,800 units. Tucson sales also rose over 10%. In Hyundai's compact car lineup, Accent sales were up almost 40%, while Elantra sales jumped 33%. Amid the otherwise good news, sales of Hyundai's popular Sonata model slipped to just under 7,900, down 48% from last year. That's raised concerns that a sales slump for mid-size sedans could drag down the company's sales figures overall. This could spell trouble for Hyundai, which is already bracing for stronger protectionist measures under U.S. President Donald Trump. Trump has made it clear that he will implement policies that advance his America First campaign theme by reviving the manufacturing sector and creating new jobs. The auto industry is one of the areas that could be hit hard if Trump imposes heftier tariffs on exports. Amid such concerns, Hyundai has reapplied for membership with the American Chamber of Commerce, which is seen as a bridge for bilateral economic ties. Hyundai also recently announced plans to invest $3.1 billion in the U.S. over the next 5 years. That's up about 50% from the previous 5-year period. Although the automaker said the investment has nothing to do with Trump, it comes at a time when the new American president has threatened higher tariffs on imported vehicles and vowed to cut taxes and regulations for companies operating in the U.S. He recently urged America's big three automakers to build more factories in the country, and other foreign automakers have announced new investments in the U.S., including Toyota, which will invest $10 billion over the next 5 years. Kim Min-ji, Business Daily.
In its first meeting since President Donald Trump took office, the U.S. Federal Reserve stayed put on interest rates. It also gave an optimistic outlook of the U.S. economy, suggesting that the Fed was on track to tighten monetary policy this year. Our Eunice Kim has more.
In its first meeting in the era of Trump, the U.S. Federal Reserve kept its benchmark rate unchanged at a range of 0.5 to 0.75%. In a unanimous statement, the Fed said its outlook for the world's top economy was upbeat, noting that measures of consumer and business sentiment have improved. It highlighted that the unemployment rate, currently at 4.7%, was still hovering near its recent low. It expected inflation to rise to its 2% target in the medium term. There was no firm signal on the timing of the FOMC's next rate move. Back in December, the Fed had raised the benchmark rate for only the second time in a decade and hinted at 3 rate hikes this year. Pundits believe the next increase could be delayed as uncertainty remains on the timing and the details of new President Donald Trump's economic plans, most of which are expected to drive prices higher. The Fed insisted that increases would be gradual, as faster rate hikes to curb rapid inflation could be dangerous. On the markets, the U.S. dollar and stocks were little changed as investors had widely priced in a Fed that leaves rates untouched. Eunice Kim, Business Daily.
Now, the Trump administration has stepped up its criticism of Germany, Japan, and China this week for allegedly devaluing their currencies, raising concerns that the U.S. might be leading the world into a new round of currency wars. Take a look.
You look at what China's doing, you look at what Japan has done over the years. They play the money market, they play the devaluation market, and we sit there like a bunch of dummies.
Trump has said it loud and clear that he believes the two countries, China and Japan, are currency manipulators. Currency manipulators are countries that try to artificially set the value of their currencies in relation to others for their own economic advantages. Following Trump's remarks, the yen strengthened, touching a two-month high of 112.08 yen to the greenback. Also this week, Trump's trade advisor slammed Germany for using a quote-unquote grossly undervalued euro to gain an unfair advantage over the US and the rest of the European Union. To this, German Chancellor Angela Merkel denied that Berlin was trying to influence the valuation of the euro. In the midst of all this, there are growing concerns that Korea is not safe from the looming global currency debate either, especially with the US having put Korea on its currency watch list last year.
And to tell us more about this, Professor Kim Se-won from Ewha Women's University joins us in the studio today. Great to have you here.
Great to be here.
So has the United States provided any basis for accusing Japan, China, and Germany for manipulating their currencies?
Well, China, Japan, and German governments all deny officially currency manipulation. But today is actually Japanese government's official response to Mr. Trump's accusation was two words, totally incorrect. But US government has its own definition or standard of currency manipulation. When a country's central bank's foreign currency purchase exceed 2% of its GDP, they define the country as a currency manipulation. So according to this US standard, China, Switzerland and Taiwan are currency manipulating country in the last year, but Japan, Germany, and Korea are not currency manipulating country.
Now then, what's the difference between currency manipulation and making use of policies like monetary easing?
Well, that's a very important point. Actually, there are two fundamental reasons why these countries are purchasing foreign currencies. The first is trade surplus. For example, when Samsung Electronics sells smartphones in the United States, they bring back the US dollars to Korea.
Right.
And they need to exchange that US dollars into Korean won. And the second reason is quantitative easing or more supply of the domestic currency. So these two could be misunderstood by US government as a currency manipulation.
Now then, what have the real effective exchange rates been for currencies that are in question?
Well, real effective exchange rate is the most accurate exchange rate. That includes the effects from price differences and trade differences between countries. So in terms of the real effective exchange rate, it is true that US dollar has been appreciated over 13% in the last 2 years. But at the same time, Japanese yen and Korean won were also appreciated by 10% and 1% respectively. But depreciated currencies are Chinese yuan and euros, which is good for their export. They were depreciated by 6% and 2% respectively in the last 2 years.
Now, of course, Korea will not be free from this looming currency debate all over the world, considering that the U.S. has put Korea on its currency watch list last year. And also, Korea has maintained a large trade surplus with the United States.
That's correct. It looks that as of now, the main targets of the U.S. government would be China, Japan, and Germany. For example, Chinese trade surplus with United States is 13 times larger than Korea's.
Wow.
And Japan and Germany's trade surplus with U.S. is about 2 to 3 times larger than Korea's. But after that, U.S. government will be more focused on Korean trade surplus with the United States sooner or later.
Now, the Korean government has said that it will review the idea of reducing trade surplus with the United States. But how does it plan on doing that? And also, what kind of measures need to be put forth amid growing trade protectionism, especially over in the U.S.?
Well, last year's Korea's trade surplus with the United States was $26 billion, which is 7th largest in the world. But actually, the trade surplus against the United States is slowly decreasing from 2015. So given more pressure from United States government, the Korean government is trying to reduce total surplus with United States by inducing more direct investment in the U.S. territory, like building new plants or participating more in U.S. infrastructure constructions.
And also, what measures do you think the Korean government should put forth in response to this growing trade protectionism?
Well, actually, in the long run, the only solution is we need to more diversify our trading partners beyond China and United States. Good examples are South American countries and South Asian countries.
All right. Well, what kind of potential impact do you think this conflict over currencies may have on the global financial market?
Well, actually, it looks that Mr. Trump's administration's protective trade policy and exchange policies are not based on economic reasoning, but rather based on domestic economic needs. So they need to devalue US dollars for maintaining the growth of their export and economic growth. So given that situation, if major economies like China and Japan reacts in the same way, there could be a currency war between major economies. And then global economic trade size will be decreased sooner or later.
And Korea won't be an exception.
Exactly.
From that. All right. Thank you so much for coming in today.
Thank you very much.
And that wraps it up for today, but we'll be back tomorrow with more at the same time, same place for your Business Daily. So don't forget to tune in then. Thanks for watching, and goodbye.